Hey everyone, Greg Sarenman, Mission Advisory Group, with a little primer on beta and why it's important. You may have heard of beta, you may not know of what this is, so regardless, let's just go through a really quick example and why it's important. So, beta is a measure of the volatility of a market. So let's take the S&P 500, the 500 largest companies in the US, put them into an index and look at it as the S&P 500 and what's the volatility of that. It has a beta of 1. That's the central measure. So just get that in your mind when you're talking about beta. It's always going to be in reference to, is it more than 1 or less than 1? Now, if you have a beta of 1.2 on something like a stock or a portfolio, then you're expecting that it's going to move 120% in relation to whatever the market, the S&P 500, is moving. Makes sense? So if it's less than 1, it means it's going to move less than the market, and if it's more than 1, it's going to move more than the market. So what do we mean then when we hear this thing about low beta or high beta? If we hear low beta stocks versus high beta stocks, it just simply means that a high beta stock or a high beta investment is going to have more risk than the market, and it's going to move much more when the market moves, in theory. And if it's a low beta stock or low beta investment, it's going to move, or is expected to move, less than the market. So it's a measure of risk when you're looking at getting into an investment or managing an overall portfolio. So the way that we look at it is we try to measure, rather construct portfolios and trade them in a manner in which they will have less beta than the market, but will outperform. I mean, that's really when we're hitting our North Star, is if we can do that. So we've just come through an environment where everything is performed that is considered high beta. So it's the easiest time to make money in the market. If you want a little more insight onto how we view things in terms of market seasons, economic quads, go over to our how we invest page on our website, and you'll see a graph, you'll see some information on there and some videos that explain this. But essentially, we've been in a period since COVID hit in last year, so go back to last summer, where growth has been accelerating and inflation's been accelerating. And what happens in that environment is that anything high beta performs. This is why there was a trap at the beginning of this year between hedge funds and the Reddit crowd, because all of the meme stocks were performing as they should and as they would. Hedge funds writ large had short bets placed against high beta. They had short bets placed against high beta stocks in the worst possible environment to place short bets on high beta. You didn't want to do that because, again, you had growth accelerating, you had inflation accelerating. It's what we would call a quad 2 environment based on the research that we subscribe to through Hedge Eye Risk Management. They were the ones that coined the term quads. They would call that a quad 2 environment. Not only was it a quad 2 environment, but it was a steep quad 2 environment, which means that you really have an opportunity to make money in those high beta places. So we've just come through that type of environment, and it's the reason that hedge funds were getting squeezed, because they had short bets on these stocks, meaning that they thought that these stocks were going to perform poorly, so they bet against them. And what happened was, it was the worst market environment to try to bet against those high beta stocks. So high beta means you're taking on more risk in the market. Low beta means you're taking on less risk in the market. When you think about low beta, think about things like consumer staples and utilities. Some healthcare could be included in that as well. So things that are of what you would call, greater value in terms of their pricing. They're not going to be the high flying growth stocks, whereas high beta is going to be like your growthier stock environment, like tech, for example, or stuff that's really been beat up, or just junk. Junk performed as well because all the high beta stuff was performing. So the junkiest of the junk debt, the excrement that's out there, has all done really well. And by the way, the Fed bailed out junk when COVID hit last year. So, I don't know, what can you do? I mean, global financial crisis, they bailed out the big banks. COVID hit and they bailed out all the crap, like the junkiest of the stuff that you want to own. So anyway, hope that gives you a better understanding of what beta is. So think of it as, beta is 1, which is equal to the S&P 500, or the overall risk of volatility in the S&P, and anything above that, any measure above that is you would expect to outperform when it's up, but you'd also expect it to perform worse when it's down, when the S&P is down. So you're taking on more risk. And then a beta of less than 1, the idea is that it's less risky than the overall market as measured by the S&P 500. So hope this helps in terms of education for you understanding what beta is, why it's measured, and why it's important. Thanks.